Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. We're going to try to help you have a more successful financial retirement. We're going to talk about retirement planning, asset management, tax planning. We really do this through answering your questions. And so you can send in questions really at any time, including now, to ask Tom at talkmoneywithtom.com. You can put questions into the chat here live on the channel. And we'll be able to answer those as we go. And we always cover questions that came up, during the week from our clients and our client strategy sessions and such also. So we believe education is really important in order to be really successful in your financial retirement. The more you know, the better, even if you're working with somebody like us. And so we've created this channel. You can feel free to subscribe, hit the bell button, get notified when we put anything new on there. You can comment on those, do anything you'd like. We really try to provide this free service to try to help people move from point A to point B, at least financially in their retirement. We're also available if you want to talk to us one-on-one. You can go to the book appointment button on the top of our webpage. The link for the webpage is here on the channel. And just set up a 30-minute phone or video time to meet with Ethan and I, and we'll be happy to answer some of your questions and such too. So really looking forward to today's show. Want to thank you for joining us very much, and we'll get into the portion here. And I always like to start off with a summary of kind of what I saw happening with the stock market this week. This particular chart that you're looking at here is actually from the very top, beginning of last year on the S&P 500 to just about an hour ago. And so what we have here, as you can see, obviously, is we had a series of peaks that were declining all the way throughout the year last year, connected by that red line, finally broke through that trend line this year, went back and challenged it again, this month. And now we're having a really nice run again, and we'll talk about that some also. And we started to discuss what we call our signals. So we have a whole process, kind of an algorithm that takes a look at what's happening with the market and gives us kind of a green, yellow, red light signal. And so currently our stock market signal is two pieces: a fast signal that we use for things that have really no tax consequences, like Roth IRAs or regular IRAs, those types of things. And the slow signal we use for more of the taxable accounts. So the fast signals historically had a better rate of return, but produces more transactions. Since we don't have cost for transactions anymore, that's still kind of viable. The slower signal is more for those things that are going to produce taxes, or at least have to be accounted on the tax return. And that signal historically has done well also. So we'll see how this goes. But that signal for the fast just turned to green yesterday, and you can kind of see why. We've had this big run up here that's really kind of driving things. And so today would have been a day that we would be looking at making some changes from where we were before to, our green holdings would be things that are kind of high momentum, moving along with the markets, designed to kind of maybe outpace the market when it's going up. And the issue that we have right now is that this is the very end of the quarter. And so let me share a chart here with you real quickly. I'm going to change format so you can kind of see. So this is the S&P 500 going back again really to the beginning of 2021, end of 21 to today. And I have done this on weekly data. The previous chart we just looked at was daily data, just so you can see this a little bit easier and we can get it all on the screen. So what I did is I put in the end of each quarter. And so if you look at the end of the fourth quarter there, 2021, that was actually the all-time high that week. That was it. And then we had a nice run up in the first quarter of 2022, and right away it started down. And then the second quarter wasn't quite exactly the bottom, but fairly close before the biggest run up we've had so far was into the summer of last year. And then the third quarter, which is right next to me here, which was end of September, that was almost the all-time low for this particular downturn. It came a couple weeks later, but turnaround went up. Fourth quarter, another big drop off. A lot of you that have been watching me on a consistent basis might recall that at the end of the fourth quarter, the market was doing really horrible all the way through the Christmas break and everything. And I kept saying, there was this rebalancing happening, and that these big funds are rebalancing. In this particular case, they're selling stocks and buying bonds, and we just need to be patient. And lo and behold, beginning of the year kicks in and it takes off. And we actually had a really big January. So it seems, if you look at it, wherever it is and it peaks out at the end of the quarter, whether it's down, it starts back up. If it's up, it starts back down. And so what we want to do here, and this is something I've been cautioning people about for quite some time, you got to be careful with making really kind of judgments and analysis at the end of quarters, because it can be kind of distorted. And what's happening is, again, you have these very large pensions, very large target date funds, which are in 401ks, for example, that have certain kind of hard allocations to stock, bond, U.S., international, all those types of things. And so they rebalance those at the end of the quarter. And so some quarters are selling stocks and buying bonds, and some quarters it's just the opposite. And so possibly what we're seeing right here is a rebalance into stocks. And then all of a sudden the quarter ends and whoosh, the market starts to struggle if it was going up, or it turns around and comes back up, because it's sort of an artificial distortion that happens in a short period of time that's kind of driving these. And it's pretty clear. Now, I don't know that this pattern will continue on and on. Generally, patterns don't, especially as people start to discover patterns. They tend to then react to those prior to them happening, which essentially wipes that pattern out. But so far, at least in this, short time frame here that we're looking at, that pattern seems fairly clear to me. I mean, it's actually on a weekly basis right at the top or right at the bottom, except for that second quarter of every one of these moves. So we'll see what happens. I love that the market's running up right now. I think that's fantastic. I hope it just goes and we end up with, a new, trend that's definitely upward, because we're still in that kind of zone right now where if you go through the checklist of primary trend up, versus the primary trend down that we were already in, a lot of the check boxes have been checked off, but not all of them, so that could happen. Really like to see the S&P 500 get above that 4,300 peak that we had back in August. I think if we did that, we're probably off to the races. But there's so many different things that are happening with the debt ceiling and the banking crisis and, higher inflation and all these different things that are going on, and the possibility that earnings could be affected, either, the earnings reports that are coming up now or the next quarter. And there's just these pieces that are out there that are going to make it difficult for the market to run. And especially because, again, we have the Federal Reserve doesn't want the market to run. Again, yesterday, 3 interviews, and all of them were talking about raising rates and how we have to stop inflation and, all these things that would normally scare the market. And again, I think it's very interesting that the market continued up during that time frame. So here's the here's the chart using 5-minute data for the week. And so you can see, and actually that big jump there was just an open, jump that happened after there was some talk about Alibaba in China restructuring into several different companies, some excitement about that. But really, this type of trend is what we're seeing at the end of these quarters. I mean, it's going through whatever news is out there, So got Federal Reserve people coming out saying negative things, markets going up anyway. That could be rebalancing that's happening inside of these things. So, that's just kind of what we're watching for as far as that goes. And again, I hope it just keeps going. I hope the pattern breaks and it just goes and goes. We'll get back in there on Monday or Tuesday and, we'll run with it and it'll work out great. So, having said that, we just got to be a little bit careful here because it's the end of the quarter. I mean, today's the last day, so we'll see what's happening, Monday, Tuesday. Did get a report today for the PCE. Now, this is actually the most important inflation report that comes out every month that gets ignored, actually, mainly because it comes out so late. So in the middle of the month, we got the numbers for February for the CPI.
Yep.
Yeah. Everybody talks about CPI. The Federal Reserve talks about PCE, which stands for Personal Consumption Expenditure Index. And this is a basket of goods designed to look at, what inflation is. The Federal Reserve likes it better because it's more balanced between goods and services, and actually has more services, but they like this, and they've been looking at this. The problem is it comes out late. Here was the last day of March. We're finally finding out what the inflation data was for February. But look at the trend. So we peaked out in July. It's been coming down, right? Now, if you look at the last month, it actually went up a little bit in February, January report reported in February, but nonetheless, we're down to 5% on this particular index. Now, this is what's called top-line PCE. It means it includes everything.
Yeah, and the nice thing about PCE is also it kind of accounts for people's behaviors a little bit more. Say chicken breasts or boneless chicken breasts are going up in price and you don't have enough money, you might go to bone-in chicken thighs that are cheaper.
Yep.
And so PCE accounts for that while CPI doesn't.
That's right. CPI just has no like-to-like type of exchanges that could happen. Yeah, exactly right. And then so core inflation, all right, so this is where they take out food and energy from the calculation. You can see it's not as smooth. Yeah, it's been moving around a lot more. Overall trend over this 1 year period is definitely down. Yeah. And this is the one that the Fed looks at the most. And when the Fed is talking about getting down to 2%, they're talking about this index right here. And we're at 4.6. I keep seeing articles and hearing people on the TV and the radio talking about, wow, we got to get down from 6%, which is roughly where CPI is, down to 2%. That's so far. That's actually incorrect. PCE core is at 4.6. Got to get that to 2%. But it's not going to be easy, because if you look back to, late last year with that dip prior to that big jump up, we haven't really dropped that much. And so it's a little bit sticky. And we've got this situation where the banks started to struggle. So the government came out to backstop the banks. That's inflationary. Because what happens if you don't backstop the banks, everything falls apart and collapses. And so that's not good. But you don't have inflation in that environment, most likely, because of the kind of the economic downturn is so severe. So on the other hand, when you do backstop the banks and backstop the depositors, that means the banks can more freely lend. They created a lending scenario, a better lending scenario for the banks to borrow money from the government. So it keeps things going, but it might keep things going maybe a little bit faster, And so one of the big questions that's happening right now is that the Federal Reserve is trying to slow things down. Are the banks also going to be slowing things down or not? We don't know.
Yeah, but the consumer fear could also slow things down too.
Yeah, exactly. And that's we'll see how that plays out. Definitely, we've seen some consumer confidence numbers come in today that were, not as good as they have been in the past. So there's some people kind of backing off there. We did see consumer sales come out today at 0.2% for February, right? And which isn't very high. And so, the consumer might be pulling back a little bit. Could be the banking thing. That kind of definitely something we got asked about a lot. It definitely opened a lot of eyes and seems to be okay at the moment, but we'll have to see. That's still working its way through, because if credit gets tightened and banks stop lending as much, that's similar to what the Federal Reserve is doing in terms of raising rates.
Yeah.
And so that's where this is so difficult. The Fed is raising rates for a future, impact to the economy, and 3 to 18 months, depending on who you talk to and what you're talking about. And so they're looking at today's data. Here it is, PCE 4.6 core. And, we're going to raise rates or not raise rates. And really what they're deciding is for something that's going to happen in the future. And if they stack too many of these rate increases on top of each other, they find out too late that it's falling apart.
Yeah.
And then if you combine that with the banking situation, if it does get worse, or maybe it already is worse to a certain degree. So these are things that are the unknowns that are happening right now that aren't normal. This is all a result of the pandemic kind of driving things. And I do have kind of a fascinating, this is a chart for the federal funds rate. This is what they charge the major banks, right? And so you can see, this goes back to 2019. We had rates were actually coming down just before the pandemic. There was some economic slowdown happening, but then you can see that cliff. Once the pandemic hit, they lowered it to effectively zero and more or less stayed down there. And then you can see the pretty steep increase that we've had.
Yeah.
It is curving, right? So it's starting to flatten out. And so the expectation from the Fed is that we'll have one more rate increase some point this year, probably the next meeting. The market's looking at a 50-50 bet for core point increase next meeting. And then they would be done for the rest of the year. And you can kind of see that curve happening, right? All right. So This is very fascinating. But that big drop created easy money combined with all the stimulus checks that were sent out and everything, created inflation, saved us from a depression, but is now really painful to unwind. It's created scenarios where banks are going out of business and those types of things, right? So, because that easy money, people don't always do what they're supposed to do with that money. And then once that money gets tight, you get to see, who's falling apart and who's in the right spot. Now, if you look at the market, and this is the bet for January of 2024, is saying right now about 4.4%. Okay, and that's a little bit below where we are right now. And the Fed's talking about another rate increase on top of that. And so I just bring this up because this is one of the big things that the market participants are talking about all the time right now, which is just the fact that the market is expecting the Federal Reserve to lower rates, in this case, roughly about 50 basis points, about 0.5%, before the end of the year. Well, that's super interesting because the reason you would be lowering rates is because there's an economic slowdown, and probably because they overraised rates or something breaks or, something's happening. So the market's looking at that and saying, okay, with these rate increases and the steepness of that rate, curve, something's going to happen and recession's going to hit, earnings are going to drop, and, the Fed is going to actually have to lower rates. And unfortunately, when they interview, people like Chairman Powell, the head of the Federal Reserve, and they ask him, he says, no, I don't see lowering rates at all for the year, right? And so there's a disconnect there that's going to be somewhat of an issue. Throw into the middle of all this, this debt ceiling debate, which is going to start to become more and more of a topic as we head into April. Theoretically, we're already working on extraordinary measures, I guess they call it, for funding the government. And the projections are that the government's out of money in terms of what's allowed between June and the end of August, or June and September, depending on which, projection. It's difficult to know what that's going to be exactly, but the political portion of this could create some uncertainty for the market too. So you've got a lot of interesting things going on right now. Altogether, it's really a fascinating time frame.
Yeah. So what were how did how did the market change for the bond signals?
Yeah. Let me get a back to the far shot here. So the bond signals, so we can see it better. Bond signals are turned from green on the fast trigger this week earlier to yellow. So what that means for us, green is where we're trying to buy things that might outpace the bond market or the stock market. And yellow means we're trying to buy things that are more defensive. We're still in, but maybe we're buying, in this case for bonds, shorter term things or inflation protection securities like TIPS, those types of things. And then red means we're generally, looking at T-bills or very short safe areas to try to be in and such too. So again, we have a fast and a slow trigger for those also. Yeah. And so anyway, that's what's happening this week. I appreciate everybody joining us, and really look forward to being able to discuss this with you. We are not having a show next week, but I will probably still do the summary on Friday. And we'll put that out and put that on the channel also. So look forward to seeing you then. All right. What do we have for questions?
With interest rates being so high, do I need to keep as much money in the market? Before, it felt like my money was withering away in a bank account and had to be invested to actually get any kind of return.
Well, it's a good question. Let me talk about some of the significance of that question. The fact that people are asking that is somewhat important, because when rates are really low, the stock market does very, very well because people aren't asking that question, right? So for example, if you can get a 0.5% or 1% or something, and the stock market's averaging long-term 11, it's not a big question. And so money tends to flow to the stock market. Now, you get maybe 5%, right, on a CD, the right place or what have you. You start to look at that and say, wow, why would I want to take the risk to get 11, especially because we just looked at the charts, for the last year, and things are tough and the roller coaster ride, when I could just sit there and collect 5 with no risk whatsoever. So it certainly makes some, and so what it does is it creates competition for the stock market. And that's why the stock market tends to do a little bit slower growth during these higher inflationary times, because again, CDs and even bonds and such will be paying, higher amounts. So should you be putting money into the banks? It depends on the bank, right? And there's banks are having their issues. Don't put more than 250,000 in the banks, in my opinion. But or at least you can add more than 250 to a particular bank by doing different operations. Personally, I'd probably just stick with 250 per bank, just because it's a better diversification.
Mm-hmm.
But so that's one of the problems
Yeah.
of putting all your money. So it depends on what you're talking about, and the question doesn't define that. Put all your money in the banks instead of stock market. I don't have a lot of clients that can do that. We deal with people kind of 20 million and below, right? In that range of people, if they take out the money out of the stock market and you ran their financial plan and said it was all in cash or in T-bills or something like that, most of those plans would fail.
Yep.
And it is the need for the higher rate of return, because yes, the banks are paying 5, but what's inflation right now? We just saw that core inflation was 5. Yeah, but no, sorry, top line PCE inflation was 5%.
Mm-hmm.
Let's say you're getting paid 5. Well, you're keeping up with inflation, but it's also going to be taxable. So after inflation and taxes, you never win at the bank.
Yep.
Ever. Ever. That's not true. Once in a while, but very small margins. And so the reason that people have real estate and the reason people have stocks is because they outpace inflation over the long term. Now, that hasn't been true recently, but over the long term, yeah, definitely. I've seen that very clearly.
So would you ever take it out for like a 1-2 year period?
Yes.
Take off some of the risk out of the market.
Yeah, exactly. And so if you're talking about a portion of your portfolio, sure. If you're talking about a shorter period of time for what you're trying to do, yeah, you can make an argument for that also. As far as that goes, it is very difficult to figure out when you'd come back in, if you get out, that type of thing. But you could combine. It's a very viable strategy now to have more of a 3-legged stool instead of a 2-legged stool. So in other words, you'd have stocks, you have bonds, or you're normal, and then people kind of had a minimal amount of cash, just to a certain degree, just because the rates were so low.
Yep.
Now you could make cash one of your kind of the legs of the stool, and you could put that right into your portfolio. You can buy brokerage CDs. We can do that inside the portfolio. You could make this up. You have a third in brokerage CDs, a third in bonds, and a third in the stock market. Whatever your allocation might be. There are some ways to kind of use that now, so that you have a portion of your overall portfolio that is in this kind of guaranteed area, at least for a short period of time, and then the rest is in these other areas that go up and down. Long term, they should outperform. As far as that goes. So. Yeah, I think there's some validity to it as these rates start to come up. And if the market is right and the Federal Reserve is going to be lowering rates by the end of the year, big if, but the market's been more accurate than the Federal Reserve has been in terms of predicting where it's going to go. Not a terrible time to lock in some rates, some CDs, for example, if that's true, because, if that's true, that means that the CDs will be paying less by the end of the year. So, get something, doesn't have to be really long, a year or something along those lines, and kind of capture that rate as it sits. So, yeah, it's possible.
With PCE coming down slower than expected, should we expect another hike at the next Federal Reserve meeting?
Well, it depends on when you carve up PCE. Actually, there were a couple places, like the month over month, where it was a little bit better than expected, but not by much. And so, yeah, it's a good question. Actually, they were talking about it on Bloomberg Radio this morning, and I think that it's kind of baked in already. The market is expecting a 1/4 point rate increase. May 2nd, 3rd is the next meeting, and so I wouldn't be surprised to see that. Probably we'll see, that might be the top, right? At least for now, unless there's some higher inflation. I will say, here it is, the 31st of March, and we've got an entire month between now and when they're going to make their decisions. A lot can happen that could change that scenario. Because last time we were looking at a 1/4, and then all of a sudden we got hot inflation numbers for January. Oh, we're looking at a 1/2 point. The market's kind of freaking out and coming down. And then the bank situation happens. The government steps up and says, well, here's $1 trillion to backstop that. And that was the bottom. Actually, here's the biggest irony I find is that the Silicon Valley Bank closure was the bottom of the market for this little run up that we've had. If you go back and look, and that's not what, so we just had a banking crisis that stimulated the stock market.
Mm-hmm.
And so this is the new world order now where we backstop things and the government keeps stepping forward. And the pandemic turned out to be a fantastic event for the stock market, which is not what you would expect. And so anyway, that's the whole concept as far as that goes. And so, yeah, I think they're going to do a rate increase, irregardless, because it's 4.6% core PCE. They want to get to 2. If you look at PCE core, it's been pretty sticky over the last 9 months or so, and so they're not getting the kind of traction there that they want. I would think they're going to do that. They also keep in mind that the Federal Reserve bifurcates their 2 roles. One role is to save the banks in this case, right? And to backstop the banks. And they're not the only ones. The Fed and the White House and Treasury and all are involved, FDIC also. But they look at that and say, okay, that is done. That's working, looks good. Now, they might be wrong, honestly, because sometimes it gets out of control. But that's what they're probably saying to themselves at the moment. The other portion of their duty is to fight inflation. And so if they say the banks are okay, they can just do whatever they want on the inflation side in that mental environment. And so that's what's happening. And so does that work? But they will have to respond if there's some other problems, during the month of April here. If there's something that happens that makes them, they could go, to 0 or even cut or go to 0.5% if the inflation numbers come in hot. Because we're going to get another CPI report coming out, in the middle of April for March. So yeah, it's a good question.
What is federal disaster tax relief?
Federal disaster tax relief. So this is actually kind of interesting. Here in Santa Clara County, because of the storms that we had and the flooding and all the other issues, it was declared in our county a federal disaster area, right? So what that means is that you do not have to file a tax return or pay your taxes, which is kind of wild, until October 16th. So it has always been true that you didn't have to file until October 16th. You could do extensions. You still had to pay April, whatever, 15th, 18th, 17th. They keep changing the day, but nonetheless. So this one's different because we're in this, federal disaster area, declared area. And California has decided to go lockstep with us. I mean, with the feds.
Yeah. So if you're in a county that was declared a disaster zone, your California's state tax is matching your IRS, your federal state or payment period.
Yeah, which is kind of good. I usually have my taxes done by now, and I haven't. Here we are. 15, 18 days away, and I was, kind of happy now to hear, of course, that we're going to have this extension. So. That's pretty interesting. I find that very fascinating to me.
And the thing is, it can be an arbitrary date. So originally, for California, the Santa Clara County, it was extended to May 15th, 2023. And it was the next round of storms that caused it to get extended to October. So it really depends. And then your state and federal also are on different schedules, and it depends on your state declaring it too. So you should check with your tax provider or your tax preparer and figure out, if you're in a disaster zone or you have to keep with that April 18th date.
Yeah, we have clients all over the country that might be listening to this, and it's different in every single place, but that's what's happening here in Santa Clara County. I would assume that's true in quite a few of the other places in California where we have clients also. So it's worth checking into, but it's kind of fascinating. I mean, obviously, if you're going to get a refund, probably want to file that tax return sooner than later, so you get that refund, right? If you owe money or just can't get your tax return done, at least you've got some more flexibility here, right? As far as that goes.
And also, because of this tax relief, quarterly payments they usually make. So the fourth quarter payment that happens around January 17th and the April 18th first quarter payment also got pushed back too. So that's another plus.
Yeah. Yeah, it kind of reminds me of like 2020 when they said you didn't have to take an RMD, a required minimum distribution. And so it's kind of interesting that they do that. It's sort of a tax relief thing to deal with some of the problems that are happening in real life, and I think it's a nice setup. I like it. I'm sure the accountants will like it too until October when they're really busy again.
Yep.
So, but it'd be interesting to see how that plays out.
With my daughter's wedding approaching, is it considered a taxable gift if I pay for the wedding and reception?
Yeah, it's a pretty good question, right? Because technically, you're allowed to gift 16 or 17,000. What's the new number? I think they might have changed it for 2023, but
Yeah.
it was 16,000, and without any consequences at all. So you could gift that. Your husband or significant other could gift, another
It's 17.
16. It's 17. Okay, so 17, 34,000 to your daughter. You could gift another 34,000 to, your son-in-law. That's a future son-in-law, prospective son-in-law, hopeful son-in-law after you spend all this money. So, but what happens if it's, more than that, right? $100,000 or something, and so yeah, technically it would be a gift if you wrote out a check to your daughter for 100,000. You can only give, you and your spouse, if you have one, can only give 34,000. So the rest would be a gift.
Yeah, and so the way you can get around this is if you went directly to the vendors. So let's say you paid for the wedding and none of the money touched your daughter's bank account. That wouldn't be considered a gift because you didn't actually give her anything.
That's right. So you pay for the caterer, the flowers directly. You pay for the wedding planner directly. Those type of things. And yeah, I will say I've seen a lot of clients not do this and just give money, and they're going over the gift, but they just don't know about it and they don't report it. And the IRS isn't. I've never heard of anybody, having that come up. But just if you want to stay within the boundaries of what you're supposed to do, I would definitely just pay for the stuff directly, and hopefully it turns out to be a great wedding.
Yeah, the average wedding is about 30,000, so that's within the
Yeah,
giftable
that's
exclusion.
right. Yeah, I've been to some non-average weddings. It's kind of mind-boggling.
Yeah.
So it's fun. I'm glad I didn't have to pay for it.
Should we be concerned with consumer spending slowing down as just a kind of a sign of the economy slowing down?
Well, so consumer spending for February just was announced at 0.2%, right?
Yep.
For February versus January. But we have to keep in mind that January was very, very high, surprisingly high. And matter of fact, Fed Chairman Powell mentioned that in his question and answer session after the last Fed meeting, and said that they felt like it was possibly high because of unseasonably warm weather. Mm-hmm. Because you're comparing, oftentimes year over year to last January. So if last January was really cold and this one wasn't, you can have a jump, and it looks like things are hot, but they're just kind of a seasonal abnormality. So the fact that January was quite high and February was low, that's not surprising, because they're starting off at a fairly high point. As far as that goes, we're not really seeing much in the way of slowdown on a consumer behavior. We're seeing it in some areas, right? We're seeing it in some of the goods areas, and people aren't buying the Pelotons, because there's a shift in sentiment of what they want to spend their money on. But we're seeing money come out into services, into the different shopping and retails and those type of things. I haven't seen that. Possibly it is indicative of some slowdown. We have been talking about as a group, all the people that are involved in the market have been talking about the possibility of a recession. With this much rate increases, and we got these banking situations, we got these things that could possibly happen, and eventually, it's likely to have some type of recession. Third quarter, fourth quarter of the year, beginning of next year, whatever it might be. And so consumer behavior, I wouldn't say it is the forefront. A lot of times it takes a while for consumers to figure out what's going on, and they just keep on spending. But maybe the banking issues that happened got people to sit up and say, wait a minute here, this isn't, our normal, situation with these banks failing. And they might have cut back some. So yeah, we'll see. But I'd say a little bit caution there because January was so high. So it's a pretty hard comparable on a month-over-month basis.
Is my 401k safe if my company goes bankrupt?
Yeah, it depends on how much of the company stock is in your 401k. I don't see that as much, but we used to. Like the Lockheed has one of the older 401ks, and we used to see Lockheed stock in those 401ks. The big story of the past, of course, was Enron, and turned out to be essentially a fraud and collapsed. And the worst part of it might have been the fact that so many of these people's retirements were wiped out because they were encouraged to buy company stock inside their 401k.
Yeah, a 401k, kind of retirement plans for companies are a protected asset. So creditors cannot get them. So as long as you have money in the 401k still, that is always yours. The market value of 401k may go down, like Tom said, with company stock. If company stock goes bankrupt, that company stock goes to zero. Then you kind of are out of luck.
Yeah, and I think since Enron, I have very rarely seen any plans that even offer the company stock inside the 401k. They may still have some stock programs, purchase programs, and things that are kind of outside the 401k. So yeah, if you're just looking at like, hey, I've got this money in this target date fund, Fidelity or Vanguard or whatever it might be, is that going to be safe if the company goes out of business? Yeah, they're like two separate entities.
Yeah.
This is your 401ks over here, your company's over there, and they're not really commingling. Yeah, the company's matching or putting money in, they're paying for the administration of that 401k. So that has to be worked out, but that 401k probably just be distributed. You'd have a chance to roll it out into an IRA or something along those lines.
Yeah, it'd probably just it'd stay at that same custodian, and then they just change the titling of it.
Yeah, exactly. So that's you have no real risk there in terms of your company going out of business. Got other problems, obviously in that scenario, but not with your 401k.
Yeah, once a company puts money into a 401k, they can't pull anything out of it. The company has no authorization to do that.
Yeah, there, in the past with some of these pension pools. So some of the corporate raiders were actually looking at that pension pool because they had access to that pension pool and they could leverage that pension pool and what have you. But that's not true with the 401k. It's literally in your name on an individual basis. The pension pool was like the company's money standing behind the guarantee of your income stream throughout your retirement. This is different. A 401k is separate from the company.
If I'm still working at 65, when do I need to sign up for Medicare?
So that's signing up for Medicare is normally ignoring still working comment, 3 months before, 3 months after, right? Mm-hmm. That's the window. But you're still working at someplace and you're 65. So then you need to talk to the human resources because it kind of depends. Some places just kind of ignore it. You just keep getting the benefit, right? And so you'd be 70 or whatever. They're going to continue to pay your benefit, or maybe they're not paying all of it. You're paying half, they're paying half, whatever it might be. But nothing really changes. Some companies ask that you actually move on to Medicare. Maybe they do some type of a supplement program in that to pay for part of that or not. It depends. I've seen it all actually. So that's company specific, but you're not required to sign up. Matter of fact, you're giving you're actually giving sort of an exclusion. Mm-hmm. You can miss that window as long as you're covered by a company plan.
Yep.
And then you have, I forgot how much time. Once you're not covered by that company plan, you have to get onto Medicare within, I think it's 3 months, but it's something along those lines. You have some window. And so that could be at 68 or 70 or whatever it is. And so you don't have to worry about, I missed the window, because the window continues as long as you're covered by a company plan.
Yeah, and if you miss the window, the issue is there's a penalty, and that's why you got to be careful about this window. So you should go to HR, ask the questions that you need. Are you still kind of a covered employee? And if not, then you have to sign up for Medicare. Yeah,
now there is Part A, which is hospitalization, Part B, which is kind of, I guess, medical appointments and those types of things, and Part D, which is prescription. You can still sign up for Part A. Even though you're covered by your company plan. If you want to kind of like double your coverage for hospitalization or what have you, doesn't mean you'll get double payouts. It just means might be less holes that somebody could fall through just from that. I've not seen that very often, but it is a potential option. Obviously, you have to, figure that out of whether that's going to work for you. But
Yeah, if Part A is a premium free, and you can do that as an add-on, the only time you wouldn't sign up is if you're in kind of like in that high deductible insurance plan and you still want to contribute to an HSA, because once you join Medicare, you can't contribute any more to an HSA. So that's one kind of thing you should think about.
yeah, I had a client find that out the hard way. They were really pushing money into the HSA, getting ready for retirement. They wanted to have that tax-free growth. And they, hey, Part A is free to sign up, and they did it, and then all of a sudden they couldn't add to their HSA anymore. So it's a really good point, Ethan.
Yeah, and you can always have both plans. You could have your company's health insurance and Medicare Part A and Part B at the same time. It's just that your company's health insurance will always be the primary, and then the secondary be Medicare.
Yeah, yeah, it's a good question. All right, we have time for one more quick question. Do we have a quick one? Anything come in?
What's the difference between the federal funds rate and the prime rate?
Okay, the federal funds rate, actually, we covered that in our summary today by chance. So that just is that's the rate we all talk about. I mean, we're talking about interest rates. We're talking about the federal funds rate, and that is the rate that the Fed sets. And I think it's 4.5 to 4.75% right now. They usually have a little range. They try to keep the rate around, and that's the rate that they charge the banks. So your Wells Fargo, your Bank of America, whatever, when they borrow money from the Fed, that's what they're paying. Then prime rate is what the banks pay, what their best customers, basically, right? And sometimes there is prime plus two, things like that, where they'll have like a home equity credit line where they charge you, hey, our prime rate is 6%, but our home equity credit line is plus two, so it's 8, whatever. There's different, you'll hear that a lot, but it's just a differential between, it's usually higher, right, than Fed funds rate because the bank is paying X.
They gotta make some money too.
Yeah, you would expect to pay more than that as far as that goes, but yeah, there's a whole lineage of different rates that come through to different levels of people, all the way up to the loan sharks who charge the most. So, but that's how that works as far as that goes. But it's a good question. Okay, that's incredible. We did it again. We've got another show. Again, we won't be here next Friday. I'll try to do the summary again for the week, but we won't be here for the live show. Look forward to seeing you in a couple of weeks, and thank you very, very much for coming today.